The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes. Welcome, everyone, to the Investor Resources podcast. As always, if you find this interesting, we would really appreciate it if you go ahead and forward this to your friends and family, coworkers, anyone you think may enjoy hearing this message.
Well, if you're interested in this, you're bound to know somebody else who is too.
Almost always.
As the old saying goes, birds of feather flock together. If somebody doesn't agree with you in today's world, you de-link them from all your social media stuff.
They don't have to exist. That's right. You can turn them off.
Yeah, it's not quite the same as having them living next door and you're talking over the fence. But
there you
what
go.
we're talking about here in this session is the fact that the bears continue to have another adage, which they have hope that springs eternal, that they are right, that the market is overpriced, things are too expensive, the government debt is going to collapse the world, if not our country, and we have all sorts of economic problems, which you can argue are significant and they are real.
They're there.
So
Yep, they're there.
why on earth is the market going up in this kind of environment? So the ones who are betting on it going down are referred to as bears. They're betting that the stock market will collapse. And why would you do that? Because you can make money if you're positioned properly in a falling market. There's two ways to look at a market. One is short term, what's going on right now. Another one is to have a longer, intermediate to longer term view of the economy and things that you believe should happen. But we're not forecasters, so betting on the come is a good way to lose money, whether it's in the market or other things.
Correct. No matter where you're standing.
Nobody knows what the future is actually going to hold. But bears in the stock market have had a really hard time since the multi-month recovery coming out of COVID.
Right. It's been hard for them, and like you said, Don, the part of the reason is there is no shortage of disturbing news and statistics out there. That's not that's not something they're making up. They're looking at the world out there and they're like, there's a war going on here, there's a war going on there, inflation's out of control, the market's overpriced, this is looking bad, imminent collapse. The red lights are all flashing. This is really bad. We don't think this is good at all. And then the market continues to just keep going up, much to their disappointment, if they're positioned for shorts, if they're looking for the market to drop. And even though it's moving against them, they don't always give up. They hang in there with that belief system that, you know what, there's too much bad news. This has got to collapse. And I'm going to be there, standing as the victor when it does. In the meantime, they're losing money every single day being on the wrong side of a market move.
Well, there's a reason why people get optimistic about being bearish, particularly when you look at hedge fund returns. Most hedge funds are basically, well, they're hedged. They have positions that are going to benefit from rising price, and they have positions that are going to benefit from falling prices. So they're playing both sides of the teeter-totter, if you will. And those firms typically do a great deal of research on a company by company basis, more often than not, rather than the macroeconomic basis. So they find a company that they have concluded the financial position just simply does not support more profit and a higher stock price. And so they'll basically short the stock. If you're unfamiliar with that, they basically have plenty of equity in the brokerage account. So they borrow the stock from the broker and they sell it. Now they owe the broker the number of shares they sold. And if they're right and the stock price falls, particularly if it falls substantially, They will then buy the shares and repay the loan from the brokerage firm. So they don't owe any outstanding shares anymore. It's totally legal. It's
Yep.
done every day, sometimes in a short time frame and sometimes in a longer time frame. Uh, those hedge funds that have had horrendously big returns often have made big returns because they were right about that financial investigation and the companies came under selling pressure, the stock collapse. They finally reported really bad earnings, stock collapse. Could be a number of reasons there. Could be bad accounting, whatever it happens to be. But those returns
Sure.
become very profitable, and there's a cadre of particularly professionals who
Sure.
take the bearish side of a trading position, call it a bet, and when they're right, they can be really right. But for the average investor, these are very difficult and high risk bets to win on. They're even when we look at the market as having so many all-time highs. I think the S&P 500 has set 26 new all-time highs this year.
Hmm.
In anybody's book, that's a bunch.
That's a lot.
And it's not uncommon for people to say, well, it can't go up anymore. I mean, look how much it's already run. So I'm going to sit on the sidelines, or I'm going to bet against another rise and assume the market will fall before it goes higher.
Right.
Those are kind of the rationale that people use to make that bet. But the problem with that is that there's even historic reason to assume that given the rise in the market this year, it can still go higher. So I'm going to share a chart here, Perry. I got my
Sure.
camera in my way of where I'm going, but we can get this
Right.
figured out.
And,
I
but
want to
your
share.
last point there, Don, is so important to remember that narrative is very common. This market is up so much, it has to go down. It's going to pull back, and that's what I'm going to buy. I'm going to buy on the pullback, and sometimes you're waiting for a pullback that never materializes, and that's why that can be so dangerous.
Well, that's a pretty common rationale. I mean,
Yep,
I want to buy
very common.
low and sell higher. Everybody wants to do that. But when the
Sure.
market sits at an all-time high, why not wait for a pullback? Buy on the dip.
Yep. Yep.
Unfortunately, the dips in this year have not been very deep, so they have vanished very quickly. And this is a little piece of history that came from 314 research. It basically shows that when, let me get my mouse over here, when strong rallies in the first half actually lead to stronger rallies in the second half, or at least as strong as they move up. So they've done some basic historic research and show that when you have a strong rally in the first half, the second half just continues to go up. And if the rally is less than 10%, then the market continuation is not as strong. That's what this chart basically tells us. So we've had one of those years where the rally is meets these qualifications.
Right.
We have seasonality, and given the fact that we've met this historic correlation, this really makes seasonality a much stronger argument than it would be in just a normal year, an average year. So this chart is calendar arrangement. January here where we're used to seeing it, and December down here. But December and January are connected. So what you often get is this rally in December followed by this rally in January. And it basically confirms the same thing that we were just now talking about.
That's one of the reasons you hear about the Santa Claus rally. It happens a lot in December. You're going to get a lot of market highs, and that doesn't mean you have one every year. It doesn't happen all the time, but a good portion of the time, more often than not, you're going to get those high markets in January and in December, and there's no reason not to pay attention to that. It's just another one of those indicators that says, okay, we had a great first half of the year. What are the odds we're going to have a great second half? Better than you'd think. And so don't dismiss a market because it's been good. And that's when a lot of talking heads, a lot of newsletters will start coming out with, well, this has been too good for too long. We know it's about to turn. Well, they don't. They don't know it's about to turn, but it makes for a profitable selling of a newsletter. And so you're going to see those headlines come out.
Well, forecasts are what sell newsletters, and especially bearish forecasts.
Oh yeah, yeah.
A positive forecast doesn't create fear. And if you're not fearful of what's going to happen in the future, you're not going to take action. If a newsletter headline can forecast 40% collapse in the next 6 months, well, you're very apt to think maybe I should pay attention and figure out whether or not I really own the right stuff or if I should own
I've got to
anything at
do
all.
something. Yeah, that's it. Yeah,
Now, in the current year, we actually have some different dynamics than we have over the last decade and a half, and that is savings deposits, money market funds, bank accounts, certificates of deposit are paying an attractive amount of interest. And we haven't seen this in a couple of decades. Interest rates have been
right,
so low, people have been forced to go to the stock market to expect some kind of return. And now we basically have competition for the money that would be in stocks. So the bears have a little bit more argument, and especially if it looks like the longer term interest rates are rising, which is generally not good news for the stock market.
right.
If interest rates get back above 5%, people are going to say, why should I take that kind of risk? And the bear commitments are saying that higher interest rate is going to cause the company to lose money. They're going to have a harder time paying their bills. They're going to have a harder time refinancing debt. So the argument for the bears has some legs to it. Whether or not they'll last is something we'll find out as time unfolds before us. But
Have to let it play
that
out.
is one of the reasons. And seasonality does have a tendency to favor presidential election years. That's a favor for us right now.
Correct. Yep.
So
Correct.
we have that, and on the positive side, we have higher interest rates and money market as on the negative side. But then on the positive side, corporate earnings in this season have been about 3/4 of the time better than expected. So that kind of demolishes the bears' arguments. But then as we go back to this chart on seasonality, and it says the next couple of months we get through some pre-election sloppiness, and the next couple of months actually look like they should be pretty decent, historically speaking.
Right.
Now, as for us and our management, we don't forecast returns. In fact, I met with a prospective client this last week whose frustration over her current firm's continually forecasting and making changes that seem, in her opinion, to not work out all that well, at least in the short term.
Right. Right.
So, well, what do we do that's different? We don't forecast. We look at things as they are today. What is happening now? This is what we know. This is what we can manage from a decision model. What we don't know, we can't manage. So
That's it. And
let's
even right now, even watching seasonality, even watching, knowing that those the highs in January and the highs in December are real and they tend to occur on a frequent basis. We don't ever bank on that. We don't wait and just say, well, we're just going to stay in the market. We don't care what's actually going on. And that's what we think is the most important thing. Deal with what's going on in the market currently. You don't have to be a day trader. You don't care what the market's doing before noon every day. You look at some intermediate market movers and you make that calculation. Is money coming into this market or is money leaving? and then you make an investment decision based on that. And where is it flowing in, and where is it flowing out? And tracking the data can give you a clearer picture of where you have the best chance of doing well. Doesn't guarantee anything, but you're gonna have a much more profitable trading most of the time if you trade with the market instead of betting against it because of anything that's historical in nature.
So with this one, this basically is what we've been talking about here, is that there is this 19% return over a 63-day period. And when that happens, then instead of collapsing, more often than not, the market continues to rise. And that's
Yeah,
basically what has been happening. And so here we are here. So one of the issues, once you do have these big rises, and it was reflected in the seasonality chart, December had a big bar, and then January, which would follow, has a smaller bar. That basically means it's still going up, but the rate of change is probably going to slow down a bit. So if you're late to the game, it just means that the probability is probably on your side, depending on what you've invested in and how you made that decision.
sure.
But expecting the rapid and significant rise that occurred earlier in the earlier part of the year would be an unreasonable expectation.
And
It's
really, we're gonna look at wrapping this one up, Don. But the bottom line is, you can every day you can build a story that says you should be in the market, and you can build a story that says you shouldn't be in the market, and it's much more profitable and increases your probability of success to watch what the market's doing instead of worrying about what you think it's going to do. That's where people get confused, and that's where you can get off track. Track the data, track what's going on instead of what you think should be going on, and make portfolio decisions based on the real world numbers that are changing, and not what has happened before and what you believe is going to happen in the future. Those are both much more risky bets.
Well, none of us have received a call from Mr. Market telling us what
I,
the market's going to do tomorrow.
I know I haven't. Yeah, I'm still waiting. Good.
So one of my instructors has always said, find out what the professionals are doing and follow them. Don't try to anticipate what they're going to do. Find out where the bulk of the money is flowing into the market. That's your lead. Follow the leadership. Get rid of the things that aren't working and stay with things that are. If you like
Makes sense.
this, find it helpful, then subscribe. Use the button down below on the screen. Subscribe to our podcast. You'll get a notification of the next one. And if you like what we have today, then pass it on to your friends, family, your coworkers, people like you who are concerned about this issue will probably be interested in it also. And if you want to know, we're coming up at the end of the month. We'll be doing another live webinar on Saturday, the first Saturday of the month. You can register for that at our website, iriradio.com is the shortcut. Thanks for watching. Stay tuned for our next session.